Hello, my name is Michael Stoller, host of the Stoller Report and host of the AmTrust Title Insurance Webinar Series, Steve Napolitano, Senior Executive Vice President. Today, we have a group of wonderful female executives in the real estate business who are going to provide their views on the state of the market today and where they see the state of the market later on in the year in 2021. I'd like each and every one of them to introduce themselves and tell us a little bit about what they're doing so we can gain some insight. Robin.
Hi, I'm Robin Topol. I'm a partner at Meister, Seelig & Fine, a full-service law firm in New York with offices in Connecticut, New Jersey, and California. I specialize in commercial real estate, primarily office and retail leasing. I handle financings, acquisitions, 1031 exchanges. In the past, I've been named one of the top real estate attorneys in metropolitan New York for the last 8 years and one of the top women lawyers. My clients consist of national landlords with buildings in excess of 100 square feet, local New York landlords, as well as some Connecticut landlords with retail and office buildings. The tenants that I represent are national tenants, local tenants, restaurants, retail stores, and medical offices. Early on, I had some bankruptcy practice, which has been proving very helpful lately, as I'm working with a lot of landlords whose tenants are filing for bankruptcy. I serve on a few national not-for-profit boards, and I've served on my town planning board and architectural review board.
Thank you. Carrie.
Hi, good afternoon, everyone. Thank you, Michael and the AmTrust team for inviting me to join this esteemed group. I'm Terry Gamula. I'm president of MMDC Group, a real estate advisory firm focused on sustainability, as well as doing workouts and restructurings. I was with Citigroup for nearly a decade doing workouts with their community development group and have worked in acquisitions, advisory, asset management, investment sales. I'm also involved on several nonprofit boards in various capacities, and thank you for inviting me.
Carrie.
Hi, my name is Carolyn Pianin. I am a senior vice president at AmTrust Group. We are a New York-based asset management and advisory firm focused on helping high net worth individuals and institutional clients in crises. We have managed over 15 billion of assets during the past decade. Our clients are across all asset types everywhere in the capital stack. Right now, we are currently focused on dealing with retailers that are struggling and helping them renegotiate their leases with landlords. We are working with hospitality firms, helping them focus on optimizing revenue, as well as taking a deep dive into their operational expenses. And we are working with lenders that are trying to deal with their borrowers that are also struggling. So we have kind of a unique perspective because all of our senior team has strong backgrounds in their sector. And we are working across the country, helping all different types of clients in crisis modes.
Larissa.
Thank you, Michael and the AmTrust team. My name is Larissa Belova. I am with CBRE Global Investors. We're a global real estate investment manager with 106 billion of AUM. I work in our Americas business, and I'm the deputy portfolio manager for our flagship core open-end fund. Currently, we are working on identifying interesting opportunities for the future, as well as certainly working across asset classes in this very challenging situation that we're all in. So look forward to sharing some perspectives today.
So listening to everyone, you have four different, different asset classes that we all have. Which one do you believe is the one that's the hardest today and the hardest that's going to recover over the next 6 to 12 months? Larissa? You're the investor.
Retail.
You're
retail.
You're the one who's buying, okay? You're the investor. The others are the advisors. So Retail, you think, or hospitality?
Yeah, retail is certainly going to, well, it's already been kind of going out of favor as an asset class, and I think that it has some systemic challenges in the United States overall, and has been hit with even further challenges. Now kind of digging itself out of a hole will be interesting. It'll be interesting to see how tenants will reimagine their use of their space, how they'll run their business in the new e-commerce way, and certainly probably in a worse shape than hospitality. I think hospitality is probably more of a it's a disruption, but once things are back and the vaccine is back, things will improve.
So here's the question. We had a discussion the other day, all of us. Vaccine. How important is the vaccine? Can we continue to do business today without a vaccine? Carrie?
Sure. I'd like to comment on what Larissa said, because I believe actually that hospitality is hit harder. But I think what happened in retail was already happening in retail, and COVID was an accelerator. I think what happened to the hospitality industry was really just like lightning strike right out of the blue. Right after during the great financial crisis, occupancy in the hospitality industry went down 10%. Occupancies were hit by COVID and went down 3 times that. And I think the prognosis is so much worse for the hospitality industry, because what's happening in retail, people are going to go shopping, but you can't make up that lost income from not being able to travel. And I think without a medical solution, you're not going to see conferences come back. You're not going to see conventions come back. You're not, with the impact of the ability to have a Zoom call, people may choose to do that instead of getting on an airplane and travel. And I think hospitality just has so much of a longer recovery.
Terry, you've been involved with hospitality when you were at Citi. How do you see hospitality?
I think it's got a bit of a road to get up. I think that it's always the first to go. It's because you have to sell a room every night. You have a real-time indicator on how the economy is doing, and so it's usually the first to go in. It's usually the first to come out. I think that if with masks, and I know that, but masks have been proven to really slow the spread of this. If you go to Japan, they stayed open. They did not shut down. People wear masks everywhere there, and they seem to be dealing with it much better. So I think that if you can get into an environment where masks and spacing help with it, I think you might start to see the hospitality come back. Because I know me, I'm already looking at travel deals. I'm like, oh, they won't let me into Germany. Can I go? Or I want to go to Spain. Can I get in? So I already want to travel. So I think that's I'm ready to go back. I just would want to choose a room that has an operable window. That to me is the bigger challenge, is getting enough fresh air and ventilation in to get most people's confidence back.
So here's the question with regard to hospitality, and Robin, this relates a little bit to you with your restaurant clients. Where do we see the changes in hospitality? Because you don't want to have these large groups together in the small facilities. Rooftop lounges were a big item, and they'll still become a big item. But the question of 6 feet apart, they were never 6 feet apart in the rooftop. They were 1 foot apart. Okay, so where do you see the changes with regard to hospitality in the restaurant world and the hotel world? Robin.
I think the restaurant world is going to have a quicker partial recovery. I mean, right now we're looking at the summer. You can do outdoor dining. De Blasio says he's going to close off some streets or open some sidewalks and maybe make sidewalk permits a little more accessible. But you have big restaurants with interior space, and you're not going to be able to seat 50% of the clientele. So unless you're not going to increase your hours of dining, you're not going to be able to keep the profits. And I think you're going to have some serious restaurant failures over the next year. If they've made it through the pandemic and are still alive, I think you're going to have to see some real changes to the restaurant rents.
When you talk about restaurants, and I know this specifically, that Empire State Malkin, when they built one of the new steak restaurants on 37th Street, it was an amenity for the buildings. today we're going to see changes in the way people go to restaurants when they work. There's talking of the boxes, box lunches, and other types of situations. Do you see the high white tablecloth restaurants hurting in this market much more different than the QSR type of restaurants and so on?
Yeah, I absolutely think the white tablecloth restaurants are going to have a tough go of it. I think they're going to lose their volume of people. I think they're going to, I think people aren't going to go out to lunch because it means taking the elevator down and the elevator back. And if buildings are going to schedule your arrival times and your departure times and limit their elevator use to 4 passengers per elevator, it's going to just become a nightmare to go to lunch.
Larissa, you invest.
Yeah, I would agree with that. I mean, we're certainly in conversations with some of our restaurant tenants, and the larger format restaurants, you know, they're not going to get that corporate business, you know, whether it's the corporate dinners or the weddings or the birthday parties, and really the large groups that are driving a lot of their business. And when you're going out and spending $50 on a steak, that's not your typical kind of weekend family outing. So some of those restaurants will need to kind of work with their landlords on a plan. And some of the municipalities, you know, basically if you can use your side street, we've seen some of our kind of white tablecloth restaurants start to set up tables. So they'll offset some of that a loss, but you know, it's hard to see them be able to recover until all is back to normal, to full sales. And they're all worried about their sales as it relates to their rent.
So here you are. We have the lawyer, we have the advisor, we have the investors. How do you take care of the restaurants today? How do you take care of the restaurants, and how do you take care of the retailers? What about deferment of rents? How do you defer the rent? How long is it deferred? You know, what are the different ideas that you're going to do to handle your customers? And part of the rents were deferred based on the PPP money. So what are you doing with regard to that, with regard to your clients and so on? Robin, Carrie, and everyone. Robin?
Yes, I've been working on a lot of rent deferrals, both from the landlord standpoint and from the tenant standpoint. Most of the landlords are pretty practical. You can't get blood from a stone. And if they're really smart, they want to keep their tenants in place. They know that the tenants haven't been able to produce any business for the last period of 3 or 4 months. They don't see full capacity returning. So we're doing amendments to leases in which we're deferring either all of the rent, half the rent, the tenant's just paying OPEX and taxes or CAM and taxes, and then they're moving the rent payments, either extending the lease term or starting repayments in some cases in the fall, or in a lot of cases starting in January, in the hopes that there's either a cure or some sort of medication that people will take so that it won't be such a fatal outcome. My restaurant tenants, though, are actually, many of them are looking at closing up or renegotiating the rent entirely going forward. And that's a harder thing for a landlord to accept, that their rents are going to go down. So I'm getting pushback on that.
And are they getting pushback from the lenders on that as well, if they want to entertain those conversations?
Yes, of course, because the lenders don't want to reduce their loan. Some cases they'll extend the term of the loan, but that's got to be a smaller bank. That can't be a CMBS loan or something, as you mentioned, a bigger building where it's a restaurant amenity and you have a professional, you know, you have a professional chef that's a part of a major building development.
Carrie, you know, you represent high net worth individuals. How are they looking at this world today?
So our clients that fit into that bucket generally are owners of office buildings in New York City and up and down the East Coast. And what we are specifically doing is exactly what Robin said. We are working with our tenants to negotiate deferrals. We're requiring that they share that they apply for the SBA loans and that they apply some of their funds. We're trying not to give 100% deferrals, but working with the tenants to give us something so that they don't get used to a complete 100% deferral. So, you know, pay what you can. And then we're working with them to either, you know, if it's a new tenant, then just defer the payments. If the lease is coming up in 2021 or 2022, let's extend and apply that deferred rent to some point in the future. And, you know, those tenants are great. And then there are some tenants clearly that are trying to get out of their leases and using coronavirus as an excuse. And we're working with them too, because that's, we don't see that as really, we're trying to play fair, and we're don't see that as a great excuse to get out of a lease. So
Larissa, over the last 3 months, even though we had the crisis, you closed on certain deals and certain transactions, CBRE investors. How are you looking at transactions today, and also the other people, but specifically Larissa, how are your clients looking at different deals in underwriting, in vacancy, in operating expenses, and so on?
Sure, it's obviously very different by asset class, and I think as with any downturn, there's sort of a rush to durability of income and safe havens, and the U.S. will continue to be that space, certainly, even though we have this dislocation, and not every asset class is made equal. We've seen that in the industrial space, there's been for good quality products that's long-term leased to credit tenants. There has not been that much cap rate movement, certainly a little bit, but generally within industrial, as well as I would say multifamily in strong markets and locations, the bid-ask spread is pretty wide, where buyers want certainly some concession, and sellers are not willing to really move. And there are cases there will be folks who will need to sell because they have an IRR clock or other considerations. So those deals will close. But obviously there's been a slowdown in the market. People can't fly to do tours. They can't get due diligence done. And things will start to open up now that the country's opening up. Still a lot of dry powder out there for good quality assets.
Well, all of you represent clients and investors who are looking at, defaulting debt. The defaults aren't taking place yet, okay? Many people believe they're default because basically the banks have allowed it to be kicked down the road for 3 to 6 months. Where do you see the situation when banks and when lenders and maybe even when CMBS will start selling their debt?
Well, I mean, all of this is, I was going to say, this is a slow motion situation. I mean, the banks had a lot of legislative and political pressure to defer, to extend, whatever they needed for the next 3 months, 6 months. And so there was a huge amount of political pressure. And even if the tenant was in default in New York, the courts were closed. I mean, you're not gonna change that. And I think that pricing on debt has moved from par, essentially, for most deals down to 85-ish cents on the dollar. And a lot of people aren't prepared to take that kind of discount because they have to have the reserves against it. And this stuff tends to go very slowly. So if people are going to start moving stuff off their balance sheet, I wouldn't expect it to happen at earliest until the end of the summer, if not into 2021. There's a lot of political pressure building to not send people into default and to work it out. And from the lessons of the 90s, you don't really want to sell under duress because their, pretend and extend worked quite well in 08.
Right. Look, I can share a couple of statistics I have. Look, prior to coronavirus, 0.25% of loans were in forbearance, and now it's over 8.5%, right? You have $3.8 trillion worth of debt outstanding today. Upcoming CMBS maturities, 168 billion maturities, of which 36% are retail and hospitality, right? Since 2017, 355 billion of CMBS loans are out there, and again, that statistic, 36% were retail and hospitality. If there's going to be a wall of maturities, and since they're retail and hospitality, it's going to happen, and there will be opportunities. There will be foreclosures, there'll be restructurings, and it's coming. It's just a question of when. I mean, it's exactly what Terry was saying, but it's just a question of when and how big that wall is going to be.
So Robin's going to go back to our days of bankruptcy work to handle some of this. So here's a question that we discussed the other day. It's very fine to have WebEx, Zoom, and other situations, but it's not the human touch, and it's very difficult to really to get new clients, to discuss business with people. How do you see this remote working taking phase, or is it just a temporary event that people eventually will be going back to their offices?
Well, I think it's going to be bifurcated. I think you're going to have some people who like remote work, people who are more tech oriented and less business development oriented. I think those people will probably continue to do remote work as long as their companies will allow them to. I think in other cases, you have a company culture, you have the interaction among people, you have the need to run into people or see people or have an impromptu meeting. And I think once the virus is under management and control, I think people will, for the most part, will want to come back to work and go back to meetings and go back to in-person lunches and stop the Zooms or do the Zooms only when it's far away or less easy to meet in person.
I think it's very difficult to negotiate a deal over Zoom. You don't have that relationship. You can walk away, but it's not the same type of situation. You know, the other day when we were talking about co-working, and it was a topic of discussion. And so what's the view from all sides? Because we have different people from different sides, especially Larissa, who's in the acquisition mode. Okay, when you're buying a building, how do you look previously to COVID at co-working, and how do you look at it today?
Sure. Well, I think even pre-COVID, obviously, we were concerned about some of the credit worthiness of WeWork and the like, and regardless of that, there were some locations that WeWorking was working in, so to speak, and they were valuable buildings and they were good brick and mortar that you wanted to own regardless. I think it all comes down to underwriting. You're going to underwrite, a vacate, or you're going to underwrite your building in a way that still makes sense for the target return that you have for it. If that co-working tenant is no longer there. Obviously co-working will need to be reimagined because nobody wants to share a hot desk anymore or kind of shared amenities. This is definitely a sector that will experience some changes.
Right. I think we've seen in the last crises, right, that co-working does not work in a down cycle. I think it's evident because people can work from home or work from Starbucks, right? In 2008, people went and worked in Starbucks, right? Because they could. In 2020, you can't go to Starbucks, so you work from home. But going back to the question before, I think co-working is not. It serves a really great purpose. Right, if you're a startup firm, if you need flex space, that's a great idea, and buildings can offer that amenity, but it's not something that should be taking up 10% of New York's real estate. And I think people aren't really surprised that WeWork wasn't worth whatever it was, $40 billion. It just wasn't believable. And it became clear way before coronavirus that wasn't a real valuation.
But I think the challenge with the co-working was just that co-working took up a lot of space that was difficult to lease space in B buildings, often on lower floors. And that was space that had been vacant for quite some time. And so if some of that comes back to the market, the owners of those spaces are going to have a more challenging time leasing it, which is why they leased it to a co-working firm in the first place, because it wasn't getting leased when people had better optionality, better light, better air, wasn't on the third floor and dark. So I think it'll be, this is, still out. I don't know that I want to be in a co-working hotspot either.
Question, we haven't discussed one of the items of the asset classes, which is a major asset class in New York called the residential rental market. Last June, the legislation came into effect, having under the stabilized apartments. How do you see the residential rental market in today's world, especially as an investor, as a workout, with collections, tenants not paying their rent and so on, as a favorite asset class? Robin, or anyone who wants to take that?
Well, so far about 85% of residential tenants have been paying their rent. So I think that landlords of multifamily are relieved to see that. Some of them may be supported by the PPP, others may just still have their jobs or be furloughed or receiving rent checks. I think that as the sales for the residential come on, whether it's condos or co-ops, I think that they're going to be softened prices. I think people have learned that they need to get out of the city, or they want to get out of the city, and they can get out of the city. I think that the millennials are now at the stage where if they have a child or two children, they thought they'd always live in the city, they're going to move, whether it's to the suburbs or farther away. They can work remotely, and I think that the New York City residential market will show a short-term, be it 6 months or a year or a couple of years, of softening of prices. New York will always come back, but you don't have foreign buyers right now. Foreigners aren't coming into New York, and I think that the people who may have thought of downsizing from the suburbs and moving into the city are rethinking that. So I think the residential market as a personal investment will go down. As a capital investment, as a class, they're still paying their rents. So I think that people who own multifamily will still be fine.
Yeah, I agree with Robin on, look, we saw this migration out of, again, like, pre-coronavirus. People were leaving New York City because of SALT, and also because they could work from remotely, right? We weren't all used to Zoom, which is great, but there was, people were doing it, and people were working remotely, and people were dialing in, and people were leaving New York because of the taxes. And so you saw migration. So firms were moving to Nashville, to Austin, to North Carolina. And so I don't see that as something that's going to end. In fact, I think that, exactly what Robin said, people are going to move because it's a greater lifestyle to live in the suburbs when you have children, or if what you're looking for is a backyard, right? Living in New York City is a great thing if you want amenities like quick access to Broadway and hop on a subway and go out to a great meal. Like it's a give and take. But when the amenities in New York City aren't available and you're stuck in an apartment with 3 kids, you think, well, maybe I want to move somewhere else. But again, like I think you're going to see, New York isn't going to go away, right? Because as soon as the price starts to drop, people are going to move right back in.
Do you see many of your companies, I mean, Robin, your company has offices in other cities. Do you see your companies perhaps moving to Westchester, Jersey City, other parts of the area where the costs are less, where the transportation is different, they don't have to commute into the city, and they can accomplish a face-to-face working with people? Because the Westchester market has increased over the last couple of months on rentals.
I think some companies will. I think a lot of companies have long-term leases, so they can't quite get out of them. They could perhaps sublease. We're going to see in the next 6 months or so what hits the sublease market. I think that'll be a big factor. I think where companies have the option to move out or to build satellite offices, and the workers want it, and the workers live there, I think and the price of rent is much cheaper. Once they have that flexibility, I do think you'll have the suburban markets firm up like you did after 9/11. Your suburban markets really firmed up because people said, I'm going to get some of my backup office and some of my workers out of the city. I think the same thing will happen.
Or have you seen new leases being executed over the last couple of months?
Only ones that had been started really early, and only ones where there's a corporate need. And what I'm seeing in several cases is they're saying, well, you know what, we're not going to spend this much on the TI, the tenant improvements. We're going to spend less. And the tenants are saying, well, I had done a lease that was pretty far along, and it just, the tenant said, you know what, we'll just squeeze in where we are. We're not going to expand to this other space. So I'm seeing deals die. I've seen several deals die right now. I don't see anything new unless somebody has like TikTok, but that's been 6 or 7 months in the making prior to the lease being signed. I think nobody's jumping in the market and taking space right now. And I think people don't know exactly where the market is. They don't know what asking rent should be, whether they're going to be softened, or landlords, of course, are hoping that they'll stay the same. And I think tenants all think it's going to come anywhere from 10 to 20, and some are hoping even more percentage lower.
So for
I think I was going to say, Michael, it's okay. I think one of the challenges with the office market is that when you're dealing with the same challenges you have in an office building in New York, you have in other locations. in the suburbs. And in some cases, those buildings are not new, and they have not had the same care and attention that so many buildings in New York have been completely renovated down to the slabs with entirely new HVAC systems and stuff like that. So, you know, I think mass transit is still an issue we need to get figured out. But I also think that when you look to other locations, it may not be the mass transit, may not be the part of it. And when you look to places like Korea, where they did a very extensive study on someone who came down with COVID in a high density environment, they infected a huge percentage of people, like over 70% of the people that were on their half of the floor. That's not going to change whether you're in Manhattan or you're in the suburbs.
Question.
I think that also some of this there's a lot of naysayers on office in general. I mean, I wouldn't be in that camp. I think some of this is affecting different metros differently. You know, a market like LA, where most people are driving, is going to get back to normal a little bit faster. New York is going to have its challenges. We're New York tough though, right? So I'm in Brooklyn. I'm not leaving Brooklyn. I have a kid. I have no interest in moving to the suburbs. Sorry, Carrie, but I think there are those people who still want to be in New York, and employers want to attract employees because they want to be in cities. So to me, this is a short-term issue. Everybody said no one's going in a skyscraper after 9/11. Obviously, that's changed, and people forget. I mean, I hate to say, people do. We will get over this. We'll recover, and we'll get back to normal. It just depends when we have a cure.
Right. I think that's good news. I think that's great news, right? That we're going to get past this. There is a light at the end of the tunnel. There will be a cure, and then we'll have a new normal. It won't be like this. It may not be exactly what was before, but people will go back to wanting to be in offices, wanting to have that creativity, the collaboration, asking people, stopping people in the hallway and asking them a question about a transaction that you're working on. We don't have that right now, and we're missing it.
So here's the question. Where do you see the greatest opportunities for each one of you and your clients over the next year? Okay. Is it, Larissa, is it buying buildings at discounts or properties at discounts? Carrie, is it your high net worth individuals looking at a different type of category? Terry is an advisory. And Robin, what do you suggest? Because people come to you and say, what should we do? I don't know what to do. You know, it may not be the right time to make a decision, but I don't have my crystal apple right here. But I normally say, where do you see the opportunities? So we're going to start with Robin, then we're going to go to Carrie, Larissa, and then Terry. Robin.
I think the opportunities for tenants who have leases that are expiring or they're willing to do renewals is that I think it's going to be a bit of more of a tenant market for the time being. I think they'll be able to negotiate better with landlords, both office and retail. I think anybody who's folded up their tent and closed up and now wants to reopen in a new situation will have the negotiability. I think they'll be able to get more free rent. I think they'll be able to get a landlord who's happy to have them. And I think there'll be more opportunities on a tenant side.
Carrie.
I think that, with each of these crises, you have to understand sort of what caused it, and then be able to sort of see through the fog. With the great financial crisis, it was a lack of liquidity, and today it's sort of a lack of connectivity and a lack of movement. I think that the opportunities are going to be figuring out new uses, perhaps for shopping centers that have failed. And if you could come in and figure out a better, highest and best use, because so many of them really are in great locations, or it's buying hospitality that just didn't make it, but it really could be. If we don't get to a medical solution soon, there are going to be so many hotels that fail, not because they were bad, but because they can't survive not being open. And those then, if you could buy them at the right time and then ride that wave when they open up, that's an opportunity.
Maybe part of those hotels can be used as dormitories or other type of places.
But those, I think, if they can be dormitories, they will be dormitories. So those aren't going to be the ones that fail. At least I hope not. I don't
Right.
hope any of them fail, actually. I mean, it would be great, but, you know, we are
Larissa?
where we are.
Yeah, I think it's really all depends on what the capital is and what your appetite for risk is. The next few quarters will be really an opportunity for all cash buyers to be able to potentially pick off some excellent assets at lower values. There will be sellers that need to sell because they won't be able to refinance, or because their NOI in the building is now lower, and maybe you're capping a lower NOI. So we've been through the longest economic expansion and real estate cycle, and we finally have an opportunity to buy some assets at hopefully lower values. And normally, the herd is running away. Maybe you should run the other direction. So on the value add and opportunistic side, there should maybe be opportunities in a city like New York where nobody wants to be there. Maybe you can get some great deals across asset classes.
Terry.
Prices are sticky downward, so I'd agree with you, Larissa. When someone really needs to sell, this is a great opportunity, and I'm a big fan of the lifeboat theory of investing, which is that you want to be where other people aren't. Too many people drive down returns. I think I'm going to take a bit of a contrarian view here. I think that the hotel readaptation, I think that's absolutely probably going to be, if we can't get business travel back in a reasonably short period of time, that certainly could be a great opportunity for folks, as with the malls, which are in fantastic locations, but have a lot of legal issues around them sometimes because they've all been subdivided and cross-collateralized, and there's a lot of very sticky stuff there, which could be interesting. And I think that for other folks, one of the things to be looking at in all of this, we're so focused on COVID-19 that we're also missing the big wave of, certainly driven by European investors, on climate change and sustainability. There is a tremendous amount of capital that's coming into the system that is really looking at these issues, because they're not worried about what happens in 5 years. They're worried about what happens on the second reversion. And they're worried that they're going to get left with stranded investments. And, right now it's happening sort of on an ad hoc basis. Oh, you want to finance this hotel in Florida? It's been flooded 3 times. I'm not really interested in being an LP on this. It's going to flood again. It already flooded. So I think that, that's where there's some opportunity, is to look into that market and say what's going on. Because right now everybody's focused on COVID, and that's where we were headed, and that's where we're going to be back to, especially in this environment. It's being taken quite seriously in other places, and discussion is going on things like on how much carbon goes into buildings and how much carbon comes out when you have to take them down, and they're being built with fasteners that can be reused. I mean, the discussion is completely different than what's going on here, and I think that it's a real opportunity here over the next 5 or 10 years, and it's going to expand beyond New York.
So here, one last question: which borough or which region or which area do you see the greatest opportunity? Is it in the Bronx with what's the opportunities in development? Larissa, you're in Brooklyn. Brooklyn is booming. Let's hope it continues to boom. Is it the suburbs, Robin, over there? Carrie, where do you see the opportunity that people are saying? Because, it was Inwood over there, was the Bronx, it's Harlem and so on. But in your own view, where do you see the great place that you'd want to live, work, and to be? Robin?
I think Manhattan's always a safe bet. I think Manhattan will never lose its value. I think retail, office, residential, Manhattan is always king. So I think that if you're patient and you can buy it right, you can hold and you can make a fortune in Manhattan. I think the other boroughs, I'll defer to everybody else.
Yeah, I'm with Robin. I mean, I while I don't reside in New York City, like, to me, like, that's a place where maybe your values are going to fall, but they're going to come back, and they always come back stronger than anyone ever expected, and they always come back higher than anyone ever expected. And if you can, just kind of wait out one of these downturns, you're going to be fine. I love New York. So,
Larissa?
Yeah, it depends what asset class you want to invest in. I would say in New York and our tri-state area, like last mile industrial, that's been a hot commodity, and going to continue to see maybe ways that we can repurpose some of our older vintage assets around here. And I think that is an interesting asset class. It's expensive though.
Terry,
That's one asset class that hasn't lost value.
Terry.
I was going to say Manhattan, but that just seems so boring. So I'm going to go with Queens.
Okay. So I'd like to thank Robin, Carrie, Terry, Larissa, the team at AmTrust title, Stephen Napolitano, Senior Executive Vice President, for being here, and we'll be back in a week or so. Thanks again.
Thank you, Michael.
Thank you.
Thank you, Michael. Thank you, AmTrust.
Thank you.